personally, myself, I've been getting more and more constructive on duration, but still I am not ready to go sort of all out and push that duration lever for my portfolios. And it's really two-pronged. One is I think, the near-term tailwinds behind duration really came from the fact that for all that we feared about the immense Treasury supply that was going to hit the markets and potentially no demand from all your traditional buyers, all it took was a little bit of data to anchor us back in the fundamentals again. And the fundamentals for me has always been, and I think we've talked about this several times, this theme of disinflation that I think will continue to play through and all through 2024. But this lack of demand for treasuries really is just about how good the economic environment is. And this Goldilocks scenario is probably going to play on for a little bit longer, into the end of 2023 and probably early 2024 as well. And that's why I'm not ready to go all out on duration yet. But I'm definitely getting more constructive. I've probably been getting even more constructive on the front end because the Fed is running out of reasons to get incrementally more hawkish as more of the data comes through. So I do think that when you see the data start to continually soften and it's no longer about benign disinflation, you will get the demand come through because when you need havens, the demand always comes through for treasuries.
But is it safe to operate under that expectation? Because I completely take your point when we're talking about, that safe haven buying and, if everything goes to hell in a handbasket. But do you think that would then incentivize a more normal profile when we're talking about further issuance? Because I cannot fathom a situation where we don't have issuance continually growing, considering the fiscal side of the ledger over there in the States and the fact that they've almost been gaming the system to avoid duration to that effect. So with that in mind, are we thinking that duration comes in tight or, at around about the 4 level?
I think that when you look across all of history, when you just focus on the supply side of the equation, supply rarely goes hand in hand with yields, right? So what you're arguing basically is when there is a surge in supply, yields should go up because assuming demand stays constant. But quite frankly, supply usually only goes up because the economy needs more fiscal stimulus. And now, look, going into 2024, I'm not saying that, typically in an election year, you're not going to get some massive reining back of fiscal spending. That's for sure. But the fiscal pulse relative to what we've seen over the last 2 quarters is decelerating for the US. And for me, it's the change, it's the delta that matters for, this demand supply dynamic. And net supply alone is never enough to determine forever the trajectory of bond yields. So yeah, if I had to bet at the end of 2024, are yields on 10-year treasuries going to be, under 4 or above 4? Under 4 is definitely the way that I would bet. And my bet is that by that point, the yield on 2 years is going to be far, far lower than where we are seeing it now, and the curve will be normalized to a upward sloping shape.